Hello, welcome back. My name is Patrick Boyle and I'll be teaching Applied Portfolio Management today. And so this is class number 4 of my series. And as I mentioned earlier, the first half of the series is all about traditional asset management. And the second half of the series will be about alternative asset management. And so this is lecture number 4, the final one of the first half. So the next classes after this will all be about alternatives. So today we're going to be learning about fixed income investment management. Now obviously if you haven't seen the other videos, you should watch those ones first, where we covered risk and return, asset classes and equity investment management. Today we'll be learning all about fixed income, and fixed income basically is bonds, but unfortunately not these bonds, not James Bond, but investment bonds. So it's a less exciting video than you might have hoped for. So we'll learn what is fixed income, we'll learn how fixed income securities are valued, we'll learn about the sources of risk in fixed income portfolios, and then we'll also learn about passive, active and other investment strategies that people might follow when investing in bonds. So the first thing we're going to talk about is just what is a bond. And a bond is a loan usually. It can be a loan to a company, and we call that a corporate bond, or it can be a loan to a country, and then we'll call that a government bond. And basically there's a lot of terminology around bonds, but originally they would have been issued as paper securities like what you see on the screen here right now. And we have terms like the coupon payment of a bond. And the reason they were called coupons is originally bonds had these little coupons attached to them where the interest could be paid. And so you would cut off these coupons, bring them into the bank or bring them into the issuer, and they would send you the money that related to the interest payment on that bond. So these were coupon bearing bonds, and that is how they worked, and that's why they're actually called coupons, where we talk about the interest payment on a bond as being a bond coupon. And so you'd bring all of these one by one in as they mature, and you would receive that interest payment. And then finally when the bond comes due or expires, you would bring the top half in, and you would receive back both your principal and the final interest payment. So that is a bond. So fixed income refers to all securities that provide or promise to provide contractual payments during their lifetime. So instead of being like an equity that we talked about in the last class, which is ownership of a company, this is a loan to a company from an investor, and the investor has bought these bonds, lending money to the company with the idea of getting these fixed income payments, or getting contractual payments that will arrive over the life of the bond. And so fixed income securities often make regular payments of interest, so they might be quarterly, semi-annually or annual coupons. Now, not all bonds do pay coupons. We also have a thing that's called a zero coupon bond, and that is a bond that's issued at a discount. So it might be, we'll say, issued at $900, and in a few years' time, when that bond matures, you can redeem the bond for, we'll say, $1,000, its face value. So it's bought at a discount, and then when it matures, you get a larger sum of money back, but there's no interim payments, there's no coupons. So what else have we got here? Bonds, notes, and some money market instruments are all classified as being fixed income instruments. Some are variable interest, so even though they're called fixed income, the payments may not be fixed. An example of that would be something like what's known as TIPS, which are Treasury Inflation Protection Securities, and the coupon that you receive on those type of bonds relates to the level of inflation that's observed in the economy over the life of Treasury Inflation Protection Security, or TIPS. So that is sort of a quick introduction to what bonds are. And so let's now talk about why someone would want to own these. Well, there's a few reasons we've got up here: diversification, income, and opportunity. So diversification is essentially that within an investor's portfolio, there might be a bunch of different securities. And we talked about that in yesterday's class, which was on the topic of asset allocation. But essentially, high quality bonds often play an integral role in an investment portfolio, simply because they tend to not be correlated to other investments, like we'll say equities, for example. And so that might overall reduce the risk of a portfolio, both from the diversification point of view and also just because often bonds are lower risk than stocks. Now, that's not always the case. There's also things like high yield bonds, which are often also referred to as junk bonds. That's sort of a kind of a slang terminology for them. And they will be bonds that are issued by riskier issuers, and those bonds will have quite high yields and might actually give you a similar return to equities. But equally, in a good economic environment, they'll do well. In a bad economic environment, they won't do well. So that is the first argument as to why you might own bonds, which is simply diversification. The next reason that you might want to own bonds is income, and that's sort of in the name, fixed income securities. And there's a lot of investors that just want to receive a certain cash flow from their investment. So we'll say certain investors like that, they might invest in bonds, they might invest in things like rental properties, or they might invest in high dividend stocks. But the reason they're investing in any of these three things, or at least one of the reasons, is that they aim to receive these cash flows that are associated with it. And we'll say, for example, a retired person might quite like having a portfolio of bonds because it simply means that they'll receive maybe a quarterly or semi-annual, or they'll receive a cash flow basically that they can maybe spend in order to fund their lifestyle. So that is a big reason that certain investors like to invest in bonds. Now, another reason is just security, in that often bonds are a safer investment than stocks because they are a loan to a company. And as I explained in the last class when we talked about asset classes, the idea of that is that a lender to a company usually gets paid first before the owners of a company get paid. So they're higher in the capital structure and thus a safer investment usually than a stock. So if a company is issuing bonds and stock, usually the bonds are a safer investment, but equally they'll have a lower expected return. And then finally, we have here opportunity. And so at certain times, certain sectors of the financial markets might be more attractive than others. And so as the economy is changing, investors might feel it's reasonable to invest in bonds simply to take advantage of a likely change in interest rates. So if you own a bond and the interest rates go down, the value of those bonds that you own would be expected to go up. And we'll talk about that a little bit more later. But that is another reason people might invest in bonds, is basically to get a return out of their prediction of likely future interest rates in the economy. And so bonds can add a measure of stability to a diversified portfolio while potentially delivering steady income. That's kind of how people think about bonds when they invest in them. So our next slide is on the basic features of bonds. So how do people look at bonds? How are they differentiated from each other? So a bond is usually a contract where there's an interest payment and an expected maturity of that bond. Now, that's not always the case. There are certain things like credit card receivables that are really more of an asset-backed security than a bond, but they would usually be classified as fixed income as well, and they don't ever mature, but most bonds do. They can be senior or junior bonds, and so a senior bond means that it's higher up in the capital structure and will be the first to be repaid, while a junior bond might have other bonds ahead of it in the capital structure. And so whenever that is the case, the senior bond is the safest investment, but will usually earn a lower rate of interest than a junior bond. So a junior bond is higher risk, higher return. A bond can be collateralized or be a debenture. So collateral is when certain assets are set aside as being there for the bondholders and there essentially to make the bonds more secure. And the debenture is essentially an unsecured bond. So there's no assets necessarily underlying the bonds, or nothing has been set aside as being there to securitize the bond. And so a debenture is really purely, its value is purely based upon the credit worthiness of the issuer. There can be things like a sinking fund where, for example, if money is coming in, we'll say a good example of a sinking fund bond would be there's a lot of municipal bonds in the United States, and as the municipality brings in money, they set it aside and it goes into a fund to eventually pay off the bond. And so that can be part of the structure of a bond. The bonds can be callable or puttable. So a callable bond, this is sort of relating to options that are embedded within the bond. And if you don't know much about options, I do have a series, a class on derivatives, so you can watch to learn what a call and a put is. But with regards to bonds, a callable bond is a bond that if you are the borrower, you're able to pay off that bond early if you wish to. We call that a callable bond. Usually the interest rate will be higher on a callable bond, but the borrower is able to pay it off early should they wish. Or a bond can be puttable, and that means that the investor gets to demand early repayment of the bond. And so these are two features that can be part of a bond, and obviously they will affect the value of a bond. Now, an example of a callable bond is often an awful lot of mortgages are callable. And that really just means when someone borrows money in order to buy a house, they take the money and they buy the house. But we'll say, for example, if interest rates fall a lot, that borrower is often able to pay off that mortgage and refinance at a better interest rate. So that would be a callable loan, a mortgage would be. And so a bond can be structured similarly where it's callable. And so if interest rates go down, the borrower is able to refinance at those lower interest rates and will pay off the lender. Now, of course, that's an attractive feature to a borrower and an unattractive feature to a lender. And so a lender will demand a higher interest rate to compensate them for the fact that should interest rates fall, they're likely to be paid off in full, and then they'll have to reinvest their capital at the new lower interest rate. There's other types of bonds like convertible bonds where the bond can be converted into equity in a company, and we'll talk about that in a little while as well. And then there's all kinds of other things. There's floating rate bonds, zero coupon bonds that I've already explained, TIPS, which are Treasury Inflation Protection Securities that I've already explained, and other features like a ratchet bond, which we'll talk about in a little while. So bond ratings. So bonds usually are issued by either a company or by a government, and often they are rated by a ratings agency. Now, this has become more of an issue in recent years since the credit crunch, because during the credit crunch, an awful lot of highly rated bonds turned out to not warrant those good ratings, and the ratings agencies have been sort of called into question by an awful lot of investors. But the rating is essentially an assessment of the creditworthiness or the quality of these bonds. It's worth noting that issues are rated, not companies. So there's no such thing really as a AAA company. There might be a company that issues a AAA bond, but a company often issues a lot of bonds, and based on the features of those bonds, they will have different credit ratings. So the credit rating that you hear of with regard to a bond is for a given bond issue, not for an issuer. There are a bunch of different ratings agencies. The well-known ones are Standard & Poor's, Moodys, Fitch, and so on. And there's dozens of them in truth. The best known ones are often the ones that get the most volume of transactions. Now, it's worth noting when we talk about bond ratings, who pays for the rating of the bond? Well, it's actually not the person who's investing in the bond. They don't, go to a ratings agency and ask, will you rate this bond that I'm considering buying? Instead, the issuer of the bond goes to the ratings agency and asks for a rating on that bond. Now, of course, there is a bit of a conflict of interest in there, and we saw that during the credit crunch when a lot of credit derivatives were rated by these ratings agencies, and it turned out to be problematic. And so there is this issue associated with bond ratings where the person issuing the bond pays for the rating, and you have to imagine then that the problem is that the issuer, the rating agency will view the bond issuer as their customer rather than the user of that rating, and so that can be problematic. There is a conflict of interest in there. There's a bunch of different classifications, different rankings of these bonds or ratings, and certain ones are considered investment grade and others are considered junk or speculative grade bonds. Now, you might think, well, why does that matter? There are certain investors and they are required to only invest in investment grade bonds. So we'll say things like insurance companies and pension funds may not be allowed to invest in speculative grade bonds, and therefore this rating will matter an awful lot. And should a bond get downgraded from being investment grade to a junk rating, certain types of investor will be required to actually sell that bond because they're not allowed to own it. What else? Ratings changes and values. So sometimes a bond's rating will change. It might be issued as, we'll say, a AAA or a AA or a high quality bond. And we'll say, for example, if the company goes through hard times, things aren't going well, that bond might be downgraded. And that both happens for corporate bonds and for government bonds. And we'll talk about that again in a few minutes. So here we have the two biggest credit rating agencies, Moodys and S&P, or Standard & Poor's. And so they have different ratings that they use. The AAA, it's kind of, for Moodys, it's capital A, lowercase a. And for Standard & Poor's, it's 3 capital A's, is the highest rating for either of these rating agencies. And then as we move down, it's sort of BA or double B and below that are classified as being high yield or junk bonds or speculative bonds. And so that's sort of our big difference. Now, the different rating agencies, like I said, they use different letters or different capitalization or whatever it might be to describe the quality of the bond. So people sometimes need to translate between these two things. But you'll often hear people talking about a AAA bond, and that is the highest quality. So we've got AAA, AA. For Standard & Poor's, the next one is called A, and for Moodys, it's A1 and then A, and then we move to Baa1 and Baa, and so on with Moodys, while with Standard & Poor's, it moves to triple B, double B, so on and so forth. So that is bond ratings, and they matter an awful lot. And when a bond gets moved up a rating, that means that it's a better bond and you would expect its value to increase. And when it gets downgraded, you would expect a bond's value to decrease. So then this brings us to the idea of credit, or the 4 C's of credit. And so the 4 C's of credit, you'll often hear, fixed income people talking about the 4 C's, and they are character, capacity, capital, and collateral. And these are the four things that make up, I guess, an indication of the quality of a bond. So character refers to the financial history of the borrower. What kind of financial citizen is this business? And it's almost like a credit score of an individual, for example. It essentially is tied to the willingness of a company to repay and their history of being a good credit. And so that's character. The next one is capacity, which refers to their ability to generate the cash flows in order to pay off the bonds. And so the first one, I guess, is, do they want to pay? And the second one is, are they financially capable of paying? The next one up is capital, which is the capital assets of the business. And that's essentially, it might be things like machinery and equipment within a manufacturing company, or it might be inventory or something like that for another type of business. But it is the stuff that's there that's of value within that business. And now that is different to collateral, which is our next thing, because collateral is cash and assets that are pledged to secure a loan. Okay, so collateral is something that's been pledged to secure a loan. In a prior slide, I explained the difference between a debenture and a collateralized bond. So sometimes you might, capital is there as something that exists that can, of course, be liquidated in order to pay off the bonds, but it's classified differently. It's classified as collateral when it's been specifically set aside, maybe for a specific bond. And so this kind of rates back or links back to what I explained, I think, on the last slide, where a company doesn't have a credit rating, a bond does. And the reason for that is that maybe one bond is collateralized and another bond might be a debenture, which is an uncollateralized bond. And so it's reasonable, even though it's the same bond issuer, to rate those two bonds differently because their structure is quite different. So that is the 4 C's of credit. So bond ratings, this is the outline from Standard & Poor's as to how they rate bonds. And so we've got up here, the first thing they do is industry analysis, where they look at the industry risk, the market position of the company, and the operating efficiency of the company. So that's the first thing they do, is an industry analysis. Then they look at management. They evaluate the quality of the management of a company. And then finally, financial analysis, which will look at earnings protection, financial leverage, asset protection, cash flow adequacy, financial flexibility, and accounting quality. So these are the things that Standard & Poor's tells you they look at when they are rating a particular bond. So this slide here is a slide I teach this class every year, and each year I add a different version of this slide. And this one here is news from, February 21st, 2020. Lebanon slammed by double downgrade as bond default looms. So, and this is essentially something that happens every year. It's just usually a different country. I think last year South Africa was my example. And Lebanon was downgraded deeper into junk by 2 of the 3 biggest credit rating agencies on Friday, as the nation's bondholders braced for a potential default next month. So sometimes, certain issues get downgraded. I mentioned that earlier. This is an example of it that's happening in the news right now. And so if you're interested, you can follow the news about Lebanon's economy and what's going wrong there. But essentially, it looks like Lebanon will not be capable of paying off a lot of the bonds that they have issued. And so this is a thing that happens from time to time. In fact, it really just happens all the time. It's worth paying attention to. And so just because you buy a bond that is highly rated. Now, Lebanon's bonds would never have been highly rated, but they would have been higher rated than they are right now. And then just because you buy that doesn't mean it stays that way. And so obviously, as Lebanon's financial position looks shakier in this current economic environment, the bonds get downgraded. And when the bonds get downgraded, they are less valuable. And of course, the downgrade is just tied to the fact that it seems very unlikely they'll be able to pay off their debt. And so that is something that happens now. Equally, other countries or other issuers will get upgraded from time to time. And of course, an upgrade means that the bonds become more valuable. And so if you're an investor, you always want the bonds that you have invested in to be upgraded because they increase in value, and not downgraded, because that will decrease their value. And it says here, Lebanon's bond rating is now below the likes of Argentina, Mozambique, and the Democratic Republic of Congo. And so, this is what is happening in the news right now. And so bond investors will, of course, be following all of this news. So here we have kind of an interesting slide. This is the most recent one I was able to get, but it's, I think, a year or two old, from Moodys. And this is a 1-year transition matrix. And if you're interested in this, you can also Google Moodys, have a 5-year transition matrix on their website as well. But let's just take a look at this. So up here we have a current rating and rating 1 year later. So it's really about what percentage of bonds get upgraded or downgraded over time. And so if we look here, so this year's, or the current rating of AAA, roughly 1 year later, 89% of bonds are still AAA. So that means some of them are falling. Now, we've got 3% get downgraded to AA1, which is down 1 step, and another 3% move down 2 steps to AA2. And then there's no big gaps down other than that. Now you'll see over here WR, which stands for without rating. And to explain that, there's certain bonds that just sort of disappear because they've been paid off or something like that. So 5% are just no longer available. Okay, so that's nothing bad has happened. The bond has probably been paid off, or it might have been a callable or puttable bond, and it's been called or put, and it's gone. And so it's roughly 89% stay the same, but it's really just 6% that actually got downgraded there. The rest of just, we don't know what's happened with them. We've got here AA1, which is the next step down, and you can see that 3% got upgraded to AAA, 5% got downgraded to AA2, another 5% got downgraded to AA3, and 5% are listed as WR, so it's 82% stayed the same. So as you can see, there's a few interesting things. Is that obviously a AAA bond is the safest bond, but the only thing that can happen to that is it can be downgraded. It can never really be upgraded because it's at the top. As we move down, we'll say if we move to AA2, 79% stay the same, 3% move up 1 step, and 1% move up 2 steps. And so I won't read out this entire chart to you, but as you can see here, most of the bonds typically stay roughly the same 1 year later. Some get upgraded, some get downgraded. And of course, as I said earlier, you want your bonds to be upgraded, not downgraded, if you own them. So that is that. Credit spread. So the next thing we'll talk about is credit spread. And credit spread is obviously a big part of fixed income investing. Now, the credit spread is, I guess I won't read it off the slide, I'll just tell you. The credit spread of a bond is the yield difference between a risky bond and a risk-free bond. So we'll say, for example, if we've got a government bond that's yielding 3%, and there's a corporate bond that's yielding 5%. Now, the difference between 5 and 3 is 2%, and we call that difference the credit spread because it's the additional interest that has to be paid in order to compensate an investor for taking that additional risk of moving from a risk-free bond to a risky bond. So that is roughly the idea of credit spread. But of course, there's a bunch of different ways that we can analyze credit spread or look at it. So what's my definition here? A credit spread is the yield spread or difference in yield between different securities due to different credit quality, and the credit spread reflects the additional yield an investor can earn from a security with more credit risk relative to one with less credit risk. The credit spread on a particular security is often quoted in relation to the yield on a credit risk-free benchmark security, and as I mentioned, there are several measures including z-spread and option-adjusted spread. And so I'll try and explain those quickly. Z-spread is a type of spread that adjusts for the fact that each coupon should, in theory, be earning should be present valued at a different interest rate than the final principal amount. Because if you think about a bond, if it's paying coupon, and then principal plus coupon, the interest rate that you get on that bond will be a weighted average of the applicable interest rates for each of those different holding periods. And so the z-spread adjusts for that. The option adjusted spread adjusts for bonds that might be callable or puttable, because as I said earlier, a callable bond, you would have to pay a higher interest rate if you were borrowing with a callable bond, because the fact that you're able to prepay that bond, to pay it off early and refinance should interest rates fall, is attractive to you as an issuer, but then the person who's going to buy that bond from you, that's unattractive to them, and so they will want a higher interest rate to compensate you for that. And of course, if you're going to compare the credit spread on that bond to a risk-free bond that is not callable, the problem is that we need to strip out how much of the interest rate differential is due to the callable nature of the bond and how much is just due to the credit risk of the bond. So that is option-adjusted spread. And then for puttable bonds, it'll work in the other direction, but the same idea. So yield curve. So if we look here at, this is just a yield curve. So we have yield to maturity of bonds on this axis, and on this axis we have number of years, so 5, 10, 15, 20, 25. And so usually under normal market circumstances, the term structure of interest rates will be sloping upwards like this. And so we have this is a government treasury, so the red one here is the risk-free rate, and then we have a medium risk bond and a high risk bond. And so as you can see across all of the different maturities, the interest rate is always higher on the riskier security, on the riskier bond. And so so that is credit spread. So the difference between the interest rate paid by the risky bond and the risk-free bond, and the greater the risk, the greater the credit spread. Hopefully that makes sense to you. Other credit spreads, so there's z-spread and option-adjusted spread, and unfortunately I just explained those on the prior slide rather than waiting for this one, but I'll explain it again. So z-spread is the number of basis points that you need to apply to a series of zero rates such that the present value of the bond accounting for accrued interest equals the sum of all the future cash flows. So that's essentially, that's a more complicated way of saying what I just said, which is the z-spread just adjusts for the fact that that different coupons will be discounted at different applicable interest rates. And then option adjusted spread adjusts for callable and puttable bonds. So bond valuation. So the value of any bond is the present value of the expected future cash flows. And that's sort of a standard idea in finance, that almost anything, the value of any financial instrument is the present value of the expected cash flows, and usually adjusted for risk, right? And so the credit spread adjusts for the risk, and everything else is just present valuing of cash flows. So if we have here a bond, and there's three payments, we'll say there's a coupon, and principal and interest. So the coupon plus the principal amount. They will all be discounted to the present value, and that is the value of the bond. Now, there will be different interest rates applicable to, we'll say if this occurs in 1 year, that's a year and a half, and that's in 2 years. We'll discount this at the 1 year interest rate. This will be discounted at the 1.5 year interest rate, and that will be discounted at the 2 year interest rate. And that just makes sense. And so that is how a bond is valued, and it's really just this present valuing of cash flows. So bond prices and interest rates move in opposite directions. And I'll run through this quickly. It's probably reasonably obvious to you, but it's no harm to run through this idea anyhow. So if a bond was issued yesterday at $100, okay, so a loan or a bond occurred yesterday at a 5% interest rate, and the next day an interest rate cut occurred, so the new going rate of interest is 4%. Now obviously, if you had issued that bond at 5% for $100 every year, you're paying $5 in interest on it. That bond is now more valuable, right? Because someone would rather have that 5% bond than a 4% bond. So what's happened is interest rates have gone down and the bond value has gone up. Now, how much will the bond value have gone up? It'll have gone up an amount that makes the effective yield on that 5% bond 4%, which is now the going rate of interest. So we just need to adjust the price up so that whatever $5 a year in coupon is will be 4% of the value of the overall bond. So the value of the bond would have to rise such that the price now implied a yield of 4%. So as I said, the best way to think of this is these kind of little seesaw diagrams, where if interest rates go up, bond prices go down. If interest rates go down, bond prices go up. And hopefully that makes sense to you. It's just sort of how it has to work, because it wouldn't make sense if that 5% bond that was issued for $100 yesterday, and now every bond that's going to be issued will be issued at 4%. Obviously, people would rather have the 5% bond, and so the value of that has to be worth more than $100 because a rational investor would pay more for it than they would for the 4% bond. And the amount more is really just the amount that price has to go up for the effective yield to be 4%, which is the new market rate of interest. So that is bond prices and interest rates. So callable bonds. Now, I've talked a little bit about this, but let's explain in a bit more detail. So a callable bond is a type of bond that allows the issuer to retain the privilege of redeeming the bond at some point before maturity. So if you are the issuer of the bond, which means the borrower of money, you get to pay that bond off early should you wish to do so. Now, when would you choose to do that? There's a few reasons, but the main reason is, of course, if interest rates have gone down, you're able to pay that bond off early and you're able to refinance. Now, it can equally be if your credit rating has improved, right? If your credit rating has gotten better and interest rates have stayed the same, you should still be able to borrow at a lower rate with this new, better credit rating. And so you might want to call those bonds or pay them off and issue a new one to replace it at a more attractive interest rate to you. So with a callable bond, investors have the benefit of a higher coupon, right? Because no one's going to give you this call option for free. There's going to be, you're going to have to, if you're issuing a callable bond, you'll have to pay a higher rate of interest on that. And so that makes it attractive to an investor who's buying the bond. and so it would have a higher coupon than a straight or non-callable bond. And on the other hand, if interest rates fall, the bonds will likely be called. So to a certain extent, if you're buying callable or puttable bonds, it might relate to your view as to the likely future path of interest rates. So if you think that interest rates are likely to go down, maybe you don't want to invest in callable bonds because they'll all get called and then you'll have to reinvest at a lower interest rate. If you think interest rates are going to go up, these things might be more attractive because you're being paid for this call option that you might think is unlikely to be exercised over the life of the bond. So sources of risk in fixed income, there's a bunch of different types of risks that will exist within fixed income or bonds. There's interest rate risk. So if interest rates change, a bond's value will change. And we just explained that. If rates go down, bond values go up. If rates go up, bond values go down. And so that will matter to a fixed income investor. This is more important. So interest rate risk is of greater importance to bonds that have high credit ratings than low credit ratings. It just moves the needle more for that type of bond. The other big source of risk is default risk. So if the economy worsens, all bonds will be affected, right? Because actually we're seeing that right now. This has been filmed in March 2020, and we have this whole coronavirus thing going on, and markets are down an awful lot. There's an awful lot of businesses that are closed at the moment. The shops and restaurants and so on are closed, and in this worsening environment, you have to imagine that it's more difficult for a lot of these businesses to pay off the bonds that they've issued, or to pay the banks back for any loans they may have taken. And so as the economy worsens, bonds are affected. More important for bonds that are speculative in nature, right? So obviously a gentle slowing of the market or of the economy shouldn't hugely affect a AAA rated bond nearly as much as a bond that's right on the border of, we'll say, moving from investment grade to speculative grade, because obviously if it gets downgraded to speculative grade, there's a certain amount of selling pressure, because the type of investor that's not allowed to own those bonds will just have to dump them the minute they get downgraded. So that will have a big effect. And of course, default risk is meant to be captured by the bond rating, the rating done by the agencies like Standard & Poor's or Moodys. Okay, so the next thing we're going to talk about here is the term structure of interest rate. And so what that means is there's usually a different interest rate for different expirations of bonds. So what we have here is, this is yield, this axis is yield, and this axis is time to maturity. So essentially in a normal environment, the longer you lock your money up for in a bond, so if you buy a 1-year bond, you'll get a lower interest rate than if you bought a 2-year or a 3-year bond. And you're really being compensated for agreeing to lock your money up for a greater length of time. And so that's a normal term structure of interest rate. This is what's called an inverted term structure of interest rate. And so the longer out you go, the lower the interest rate that you get. And so this is something that does happen from time to time. It's something that, will matter to bond investors, and equally it will matter to general economic analysts. And so when we talked about yesterday how an economist might look at the macroeconomy in order to work out how they might want to invest, things like the term structure of interest rates will be of interest. And there's a lot of people who argue that the yield curve tends to invert before a recession. Now that's not always true. I think there's an expression where people say that an inverted yield curve has predicted 9 of the last 3 recessions. So essentially there's a number of false triggers of that idea that a downturn is coming, but it is something that people pay attention to and care about. And obviously, if you're a bond investor, this is an unusual and an unattractive situation to find yourself in. So, bond price behavior as maturity approaches. So there's some bonds that will trade at a premium and other bonds that will trade at a discount. So we'll say if the bond has a par value of $1,000, but it's trading in the market at, we'll say, $900. Well, what you would expect is that as time goes by, as we get closer and closer to maturity, this axis here is periods until maturity. The bond that is trading at a discount will move up in value until at maturity it is worth $1,000, which is what you will be paid for it. And the bond trading at a premium will fall in value as you move towards expiration or towards maturity of the bond. Now, what are we talking about with these discount and premium bonds? Now, some of them might be issued as discount or premium bonds. So a zero coupon bond, as I mentioned earlier, it'll be issued at a discount and redeemed at par. So you might buy a zero coupon bond at $900. You'll receive no coupons over the life of the bond, but at expiration you'll get $1,000 back. So you would expect that zero coupon bond, each day that goes by, will increase in value because there's less time until you're getting that $1,000 back. Now, let's talk about what would cause a bond to be trading at a premium. Well, we just explained that if rates go down, bond prices go up. And we had an example of a bond that was issued with a 5% coupon, and then the next day interest rates fell, and the new interest rate would have been 4%. So that bond, we then said, would go up in value. So it would now be trading at a premium. So even though it pays off $1,000 at maturity, maybe you pay more than $1,000 for it, but you receive all those 5% coupons, and then eventually at maturity, you'll get your $1,000 back. But you would expect, as time goes by, for that bond to slowly fall in value until we'll say the day before maturity, it would be trading at at $1,000 per $1,000 of payoff value, and so that is premium and discount bonds, and hopefully that makes a lot of sense to you. So this then brings us to interest rate risk. If we've just explained that when rates go up, bond prices go down, and when interest rates go down, bond prices go up, then let's look at how different bonds are affected by this. So we find that long-term bonds are more sensitive to rate changes than short-term bonds. So a 30-year bond will be affected much more by a change in interest rate than a bond that expires in a few days' time. And that's simply because you've got more money, you've got money locked up for a much longer time that's going to be earning whatever that rate of interest is than a bond that's expiring very soon. So let's just look at an example here. So we do a quick calculation here, and we've got three different bonds, bond A, bond B, and bond C. And we've got, each of them pays a coupon of $90. They have a face value of $1,000. There's their credit rating, and the length of time to maturity on the first one is 5 years, second one is 10 years, and the final one is 15 years. And so what we do then is we calculate the value of these bonds, and we find that they are, the first one is worth $1,000, the second one is worth $939, and the final one is worth $856. So those are the values of the bond right now. Then what we do is we decrease interest rates by 10% for each of these holding periods. And when we do that, we can then just reprice the bond, present valuing all of these cash flows at these new lower interest rates. And of course, when interest rates go down, bond values go up, so they should be higher. And we find that the 5-year bond is worth $1,036, the 10-year bond is worth $1,000, and the 15-year bond is worth $931. So they've all gone up in value, but the shorter term bond went up by 3.6%. The medium length bond went up by 6.6%, and the longest bond, the 15-year bond, went up by 8.8%. So even though interest rates just moved down by 10% across the board, what happened was that the bond that had the longest term to maturity went up in value the most. And so that is a thing that we find, is that long-term bonds are more interest rate sensitive than short-term bonds. And hopefully that just makes intuitive sense to you that that should be the case as well. So what have we got next? So if long-term bonds are more sensitive to interest rates, well, bond prices are then also more sensitive to a decline in interest rates than a rise in interest rates. Okay, so the price will move more for interest rates falling than when interest rates go up. So if we redid that calculation that we did on the last slide, but instead of reducing rates by 10% across the board, we increase interest rates. Now, pushing up interest rates will push down the value of our bonds. And so the new prices are then 966, 882, and 790. And that means they move by a fall of 3.4%, a fall of 6.1%, and a fall of 7.7%. So if we compare those price changes with the ones we calculated a moment earlier, we can see that that they are smaller percentage changes than when the interest rates went in the other direction. So so bond prices are more sensitive to a decline in interest rates than to an increase in interest rates. And that's just the mathematics of bond pricing. That's just the way that works. What else can we find out about how bonds are affected by interest rates? Well, low coupon bonds are more sensitive to rate changes than high coupon bonds, okay? Now that should make sense to you once again if we think about it, because a low coupon bond is one, we'll say the lowest coupon bond is a zero coupon bond, where you're getting all of the money back at expiration, while with a higher coupon bond, you're getting these coupons all along and then finally the principal amount. So at least you're getting some cash flow early with those coupon paying bonds. So a low coupon bond will be more sensitive simply because the entire payment is stacked out there in the future rather than some of it coming periodically. So let's do the calculation rather than talk about it. So we take two bonds here. We've got a bond that pays a coupon of $60 and another one that pays $100. They are both 10-year bonds. They both have the same rating and the face value of $1,000. And they have a yield to maturity. They each have a yield to maturity of 12%. The first one is worth $661 and the second one is worth $887. If we decrease yields to 11%, what will happen is, of course, if rates go down, bond prices will go up. And the new prices are now 706 and 942. So as you can see, the lower coupon, the $60 coupon bond, went up by 6.7%, and the higher coupon bond went up by 6.2%. So the lower the coupon payment of a bond, the more interest rate sensitive it is. And so that's another thing we can learn about bonds. So prices are more sensitive when rates are low than when they're high as well. So based on all that information, usually when I teach this class live rather than in a video version of it, I ask the class that if you think interest rates are going to increase in the next few months, which would you rather own? A 30-year zero coupon treasury or a 1-year 4% coupon treasury bond? So they're both treasury bonds, they're both risk-free. Let's pause for a second and think about which one you would want. Well, let's think about it. We said that the longer bond, the longer length to maturity, will be more interest rate sensitive, and equally a zero coupon, a low coupon, will be more interest rate sensitive. So if you think interest rates are going to go up, that means you think bond prices are going to fall. And so you wouldn't want the most interest rate sensitive one because it's the one that will fall the most. So you would want this 1 year 4% treasury. Now, would you rather it be a callable bond or just a regular one? Well, if you think rates are going to go up, you might want to be the owner of the callable bond, because bonds only get called when interest rates go down, right? And so you'd rather have this 1 year 4% callable bond rather than 30-year zero coupon non-callable bond, right? And so hopefully that makes sense to you. All right, so duration then. So duration is a calculation that we're able to do. We've gathered all this information that different bonds have different interest rate sensitivity. So the next thing we can do is just calculate the interest rate sensitivity of various bonds. So the calculation that we do is called duration. We calculate the duration of a bond, and there's a bunch of different ways of calculating duration. There's modified duration, dollar duration, or Macaulay duration. They're really the same thing, just expressed differently. So modified duration is the one that I find easiest to understand, is the percentage change in price for a 1% change in the yield of bonds. So we're basically saying how much do we expect the bond to change in value if interest rates go up or down by 1%. Dollar duration is the same sort of thing, but it is the change in price in dollars. So rather than in percent, it's in dollars. And Macaulay duration is the weighted average time until the cash flows are received. And so that is measured in years rather than in dollars or in percent. But essentially, they all tell you the same thing, which is how interest rate sensitive a bond is. So obviously, if you think interest rates are going to go down and you thus expect bond prices to go up, you'd want to own bonds that have a lot of duration. If you think that interest rates are going to go up and thus bond prices are going to fall, you'd want to have bonds that have less duration. So that is duration, and it's kind of quite simply how much does a bond how much is a bond likely to change in price for a 1% interest rate change. So duration is an indication of interest rate sensitivity, and there's also spread duration, which is the indication of sensitivity to 100%, to 100 basis points change in spreads or option adjusted spread relative to constant treasury yield. So these are other calculations. So duration here, let's think a little bit about duration. Now duration is a linear approximation of a curved function, right? Now how do we know it's curved? Well, we know that bonds have different sensitivity to increases and decreases in interest rates. So it's not a flat function. There's a curve, and we can do that. We can just recalculate the price of bonds for varying interest rates and plot that curve. But duration, it's a little bit like delta in options, if you understand options. Duration is this linear approximation of a curved function, and so the slope in this example is duration, but as interest rates change, duration will also change. So that is so what that also means is that duration works quite well for small changes in interest rate, for a 1% change, but for very large changes, it's not as accurate, simply because the estimate moves away from the curved function that it is estimating. And that then brings us to convexity. And convexity is the amount that duration changes for a 1% change in interest rates. Okay, so it's a second derivative. If duration is a first derivative of the bond price to the interest rate, the convexity is the second derivative. It's how much does duration change for a 1% change in the interest rate. So that is convexity, and it is basically how curved is the line. So High duration bonds are the most interest rate sensitive. High convexity bonds are less interest rate sensitive. So duration tells you how interest rate sensitive it is, but if it's got high duration but also high convexity, it's a little bit less interest rate sensitive than you'd expect. Low coupons and long time to maturity bonds have high duration, and low coupons also have higher convexity. Callable bonds will exhibit negative convexity, and that should make sense in that the relationship will change for a callable bond, because obviously if interest rates go down, bond prices go up, but only to a certain extent for a callable bond, because there's a certain point at which the bond will just get called, and so you'll see negative convexity within things like callable bonds. What else have we got here? So duration convexity assumptions. So when we're calculating duration and convexity, we do this calculation assuming that the term structure of interest rates is flat, and that just sort of simplifies the calculation. Now, that's not actually necessarily the way things will work, but that is the assumption in those calculations. We assume that the shifts are parallel, and that means that all interest rates, so we said that there are different interest rates for different holding periods. The 1-year rate will be different than 2-year, 3-year, 4-year, and 5-year rates. But if we're saying that interest rates move up by 1%, we're assuming that they all move up by 1% rather than that there's any sort of change in the curve. And we also assume that bonds have no embedded options in order to do this calculation, and that relates to the prior slide where I explained about negative convexity and so on. So that is the calculation of duration and convexity. So then we'll move on to this idea of how do people manage portfolios of bonds. Well, once again, kind of like with stocks, you can be a passive manager or you can be an active manager. And of course, usually people charge higher fees if they're an active bond manager and lower fees if they're a passive bond manager. Now, a passive manager is really just trying to index, not trying to beat the mark, but give you roughly not trying to beat the market, but trying to give you roughly the return of the bond market. So they'll attempt to control the risk of the portfolio and index it. Now, that's not as easy with bonds as it is with stocks. So indexing means building a portfolio that replicates an observable index. So they might pick an index that they want to roughly replicate. There could be a high-grade bond index like the Salomon Brothers index, the high-yield index like the CSFB high-yield index. But there are problems, because with stocks there's constant buying and selling of stocks, and they're pretty liquid. As I explained, I think probably in yesterday's class, a lot of bond investors just buy a bond and hold on to it until maturity. They don't trade in and out of it. So when a bond is issued, it's liquid, people can buy it, then they put it in their portfolio and it stays there until expiration. So if you're trying to index a bond index, you might look at that bond index and see the bonds that are in there, but you're unable to buy those actual bonds because they're just not liquid, or there might be more money chasing your index than there is available bonds. There's many ways, but it's hard to do this. And so then what you're going to have to do is you're going to just have to try and find similar bonds. So you might try and match the index in terms of industry or duration and convexity or all sorts of things like that. But you can't, like with a stock index, you can just buy all the stocks that are in the index. You can't necessarily do that with a bond index. So you're always maybe a little bit more active as a bond manager than even if you're an indexer than you would be as a stock manager who's indexing. Even just things like bonds maturing and so on, and you have to then pick a new one, and it's not as easy. Building a diversified portfolio. So I took this slide from the Oppenheimer Fund's website. They're a big bond manager, and they say that you should build a diversified portfolio within different types of bond, different ratings of bonds, and different expirations and so on. And so we've got here at the bottom of their pyramid, the biggest weighting is US government bonds, then agency bonds. That means government agencies in the United States like Fannie Mae and Freddie Mac, and student loan bonds and things like that. Sallie Mae, I think they're called. And then we've got non-US developed market government bonds, so foreign bonds, mortgage-backed securities, high-grade corporates, bank loans, emerging market government bonds, and high-yield bonds is their lightest weighting. But they're essentially saying you don't just buy some bonds, you diversify in terms of the bonds, and they're arguing that you should weight them in this pyramid type manner, but obviously you can weight them however you see fit. This slide is kind of interesting. Unfortunately, it's a few years old and I can't get a new version of it, but this is bond market history. So we're seeing all of these things that have happened in the markets over a period of, what is that, about 10 or 15 years. And we've got interest rates going up, we've got the dot-com crash, we've got the September 11th interest rates going up, going down. So this green line is the level of interest rate. Various news items are listed in there. And then we've got all of the different bonds and how they performed. And I think this is also from Oppenheimer's website, but from a few years ago. And we've got different types of bonds. So we've got purple is government bonds, red is corporate bonds, yellow is high yield bonds, black is international bonds, and blue is bank loans. And as you can see, as markets have changed, as different things have happened, as rates have gone up and down, different bonds have done well and different bonds have done badly in those environments. So the best performers are at the top and the worst performers are at the bottom. And so the real takeaway of this, I guess it relates to the prior slide, where they're essentially saying that maybe you want to own a diversified basket of bonds, that some will do well in some environments, others will do well in other environments. So what else have we got? So active management, the difference between active and passive is that the active managers presume that the manager can generate some sort of alpha. And we talked about alpha and beta in yesterday's class. And that essentially is the idea that the active manager is trying to provide a positive risk-adjusted return. So beta is the market return. And then obviously you can lever beta if you want to just have high beta. But alpha is a return, a positive return that is not explained by the movement of the index or the market in general. And so that is the goal of an active fund manager in fixed income. So what can they do? You can build your portfolio however you want. You can diversify however you want, concentrate in certain sectors or not. Two approaches that are quite common amongst bond managers are this idea of a barbell portfolio, where they buy a lot of short-term bonds and a lot of long-term bonds with nothing really in the middle. And so that is a barbell portfolio. A laddered portfolio is buying equal amounts across a range of maturities. So we'll say if you had, 100,000 to invest, and there are 10 years of bonds available, you would put 10,000 in each year's bond, and as the 1 year bond matures, you would take that money and you would buy another 10-year bond with it. So you're always buying long-term bonds with the money that comes in when the bonds mature. And that's called a laddered portfolio. And the idea behind a laddered portfolio is that if you usually get a higher rate of interest for going out longer, you're always buying those, we'll say the 10-year bond, whenever the 1 year bond matures. And of course the old 10-year bond is then a 9-year bond, and the old 9-year bond is an 8-year bond, so on and so forth. Let's look at the barbell. Just to explain, a barbell is like a piece of gym equipment, if you're not familiar with that term. And the barbells are a strategy for buying short-term and long-term bonds, but none of the ones in the middle. And the idea here is that you want to get some of the long-term bonds to get that higher interest rate associated with buying, we'll say, the 10-year bonds. But because you're maybe not convinced that interest rates you're maybe hoping that interest rates are likely to go up, and so you're keeping a lot of your portfolio in short-term bonds that you'll hopefully redeploy when rates go up. That's kind of the idea behind a barbell portfolio. So as you can see here, they've bought bond A and bond B, which are 10-year bonds, and they bought bond C and bond D, which are 2-year bonds, and they haven't bought anything in the middle. So that's a barbell portfolio. A bond ladder is a portfolio of bonds that mature at regular intervals. So that attempts to minimize the risks associated with bonds while managing cash flows for the investor. So a wealthy investor might have a portfolio manager who puts them in a bond ladder. And that just means that if you've bought this ladder of different expirations bonds, there'll always be something expiring soon, and you can use that for cash if you need cash at that point in time, or if you don't, you can reinvest it, but in this longer term way. So it's a multi-maturity investment strategy that diversifies bond holdings within a portfolio. So this is an example of the bond ladder. So there's 1, 2, 3, 4, 5, 6 different expirations of bonds available in this scenario, and so you put 1/6 of your money into each of those. So 1/6 is in the 1-year bond, 1/6 is in the 2-year, the 3-year, the 4-year, the 5-year, and so on. And so what happens is that as this bond matures, as time goes by, this one matures, and you buy the next bond out here, always buying the longer term bond, trying to get that little bit of extra interest that you'll get for buying a long term rather than a short term bond, as long as the yield curve is not inverted, obviously. And so that is a bond ladder. Ladders are a popular strategy for staggering the maturity of bonds, and it can help you get that higher coupon of longer term investments while allowing you to reinvest a portion of your funds every few years. So that's the idea behind a bond ladder. And so that is our last slide. I guess we're about an hour and 10 minutes into this class, so we'll take a couple of days break. This is class number 4, and then next week I will release the next class, and we'll be moving from traditional asset management into alternative asset management at that point. So see you later, and have a great few days. Talk to you soon. Bye.